everything is in danger zone. If we go into recession, and the recessionary forces are much stronger than what people expect, because if asset prices decline, it may affect consumption meaningfully. And if that happens, maybe cash and bonds is not such a stupid allocation for the next 6 months or 1 year. I hope that gold falls another $500 to $1,000 an ounce, because then I would increase my gold position again rather substantially.
Everything in the financial system is now moving into a danger zone. Asset prices remain high, but ordinary people are already feeling recession through weaker purchasing power, rising costs, and shrinking affordability. If stocks, private equity, and credit markets begin to break, the damage could spread much faster than most investors expect. Marc Faber, a veteran investor and market historian, explains that this environment demands caution because government deficits, debt payments, and future money printing are likely to keep pressure on paper currencies. He believes gold could still fall another $500 to $1,000 in the short term, but instead of seeing that as weakness, he would view it as a major buying opportunity. His larger prediction is that precious metals may decline during a panic, but they could hold value far better than overvalued stocks, private credit, and speculative assets. In a deeper bust, many bubble-driven investments could lose 90% or more, while gold, silver, and platinum may become the safer long-term refuge. Now, we present the clips from Marc Faber's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
I like precious metals because I think that in the current environment, especially if I look at the Trump administration, I want to have something relatively safe and that is thriving and keep its value in an environment where the government will spend money like water. They're not going to reduce the deficit. The deficit will go up. And since the interest payments on the debt will therefore also go up, more money printing is only a question of time. Only a question of time. I hope that gold falls another $500 to $1,000 an ounce, because then I would increase my gold position again rather substantially. I have a substantial position already, more than most people would have, except the gold bugs like Eric Sprott. He has most of his assets are in gold, or some other people I know, they have most of their assets in gold. But most people that I know in the investment world, say among fund managers, most fund managers do not have more than 1% in gold, and already a 5% involvement in gold is a lot. I know rich people in Switzerland, they have most of their assets in real estate, in some stock portfolio, in some bond portfolio, private equity, and gold maybe, a few ounces, which they inherited from their grandmother, which bought them during World War II. In my view, private equity and private credit is a major disaster waiting to happen. And it's not just Blackstone that is kind of limiting redemptions. In Switzerland, we have a very big private equity firm, Swiss Property or whatever the name. And they also limited redemptions, and the stock has been cut more than in half. Also, Blackstone's shares are cut more than in half. The market is telling you that private equity and private credit is in deep trouble. The markets are very strange. You have anomalies that are very unusual. Consumer confidence indices are at the record low, while the stock market is at the record high. This has never happened before. Why is that? Because we have two economies. The economy of the 1%, the rich people. And I'm not complaining. I've also benefited from financial asset inflation. But 70% of Americans or 80% of Americans are the Americans that live a normal life, kind of the median household and the lower household. There are very few assets, and if they have assets, they have to borrow money to buy these assets. These people have essentially a problem of affordability. They can't afford to buy things they would like to buy, but they can't because they don't have the money. And the super rich, they already have everything. And so the economy is very mixed. The economy of the super rich who own the yachts, which they will sell later on at a loss, a colossal loss. And the economy of ordinary people, the economy of ordinary people is in recession, period. That you can be sure of. The purchasing power of ordinary people has gone down, and they're spending in real terms. They go to the supermarket, they buy, but they have to pay much more, and so they buy less. And the companies, what the companies do, because they also have rising costs, they reduce the size of helpings. So we have this shrink inflation. The poor people, like always, get screwed, period. And especially under the Trump administration. If you look at energy stocks and you compare the energy sector in America to the S&P, energy nowadays as a percent of the S&P is at the lowest level in like 40 years. We were at about 35% of S&P in 1980, and I think about 20% or 25% in 2008. And now we're down to about 5% of the S&P. So if you talk about investing in value, I think energy stocks are relatively low. I can buy a portfolio of oil stocks and they would have a dividend yield of, say, 6% and are relatively low. I don't think there's a huge risk. So I own some oil shares. But I have to admit that my stock portfolio is very diversified and globally. I mean, I have stocks in Europe and I have mostly stocks in Asian economies because I'm a believer in Asia and also I'm a believer in Chinese long-term economic development. Everything is in danger zone. You know, when I grew up in the 50s, my grandmothers and grandparents said you have to save 10% of your income and put it on deposit with a bank. Well, that advice was a disastrous advice over time because of the depreciating currency, the loss of purchasing power of paper money. They should have said, Mark, you stupid young boy, buy every day some stocks or buy every day some gold and so forth, and don't put it with a bank on deposit. But interestingly, nowadays, if I look at the asset allocation of people, the cash position of investors is at one of the lowest points in history. And it tells me that maybe, and the asset that nobody wants are treasury bonds, long term treasuries. So it tells me if we go into recession and the recessionary forces are much stronger than what people expect, because if asset prices decline, it may affect consumption meaningfully. And if that happens, maybe cash and bonds is not such a stupid allocation for the next 6 months or 1 year. You understand? And it's not a long term proposition, it's just a strategic opportunity. And I am cautious of increasing my stock position. I have a large portfolio of stocks in Thailand because the Thai stock market is one of the few stock markets that has gone down for the last 5 years.
The biggest warning is not just about gold or stocks, but about the strange split inside the economy. The wealthy still benefit from inflated financial assets, while ordinary households face a very different reality. Food, energy, housing, and basic expenses are absorbing a larger share of their income, and many people are forced to buy less even as they spend more. That is why recession risk should not be ignored. Consumer confidence is weak, yet the stock market remains near record highs, creating a dangerous gap between Wall Street and real life. Faber suggests that cash and bonds may not be a long-term solution, but over the next 6 months to 1 year, they could serve as a tactical shelter if asset prices start falling. His prediction is that a broad downturn would first expose private equity, private credit, and overhyped market sectors. Now, let's get back to the interview.
In a mad world, what is relatively less mad, it may be appearing attractive, but if the mad world collapses and we have a major financial bust, then also what is relatively low will go down. Whatever you consider, at the end, I think that in a major bust, gold and silver and platinum will go down also, but they will go down by maybe 30%, and many other things will go down to zero, and many other things will go down 98%. Say all stocks related to the Trump family will go to zero. That is my prediction. With
Well,
a
this,
relatively high confidence. I've experienced so many bubbles, and I always distinguish. There are small bubbles that, when they burst, do not cause significant economic damage. But big bubbles like the South Sea stock in 1720 in England, when it burst, it caused significant damage. Or in the 19th century, we didn't have central banks, so the bubbles were large, but they were not as large as they are today. When they burst, the railroad bubble burst, or one of them. I mean, they had many railroad cycles in the 19th century because railroad construction and canal construction were the big capital spending objects at the time. The biggest railroad bubble burst 1873 after the Civil War. And by 1895, 95% of railroads were in receivership or bankrupt. The interesting thing about the AI bubble that I need to mention, in America and elsewhere in the world, canals were a huge thing because they facilitated the transport of wheat, corn, soybeans in large quantities on ships, on canals going from river to river. And the most successful canal that was ever built in America, the Erie Canal, also went bust. I just like to mention that in England and in Holland, the Dutch East India Company also went bust eventually after having been a very successful enterprise. So I think the AI bubble, and it is a bubble, except I cannot tell you, has the bubble burst yesterday or today, or will it burst in 6 months' time? And some stocks, the market is a composition of many different stocks. So in theory, you could have one stock going up vertically and pushing up the index, and 499 stocks in the S&P not going up. The recent rise of the market this year, I'm to say, is very poor in the sense that 45% of stocks are below the 200-day moving average. There's only a handful of stocks that is making new highs. The new high list is very limited. The mood during a bubble is to get rich quick, a quote in a mania. There are books about the crowd mentality, how crowds behave. I give you an example. You walk in winter time through a winter landscape and everything is covered with snow and ice. And you come to a pond and there's nobody on the pond, you will be extremely careful when you cross the pond, and you will be afraid that they could break and you fall into the cold water. But if the village has a party and is ice skating on the pond, and there are 500 people ice skating on the pond, without any thought, you will cross the pond because other people are on it. But in reality, the ice is more likely to break when there are 500 people on it than if you're alone.
Yeah, yeah,
You understand?
yeah.
The mass psychology. And there's a very good book on the subject by Gustave Le Bon. It's called The Crowd, La Foule. He was a Frenchman, and he wrote the book in 1830 or 1832. It's a very interesting book that I recommend to your viewers and readers, because it discusses also the manias that occurred, like witchcraft. Suddenly people believed in witches. Or the Crusades. Suddenly people believed that they could liberate Jerusalem from the Muslims and so forth. And so people have, from time to time, the alchemists, they thought they could discover gold, how to make gold. They're manias all the time. I saw it as a child in my school. One year they played with beads, and another year with other games and so forth, and then collectibles and stamps and so forth. Every year something different. It caught the attention of everyone, and everybody was excited, and then it then disappeared again.
The final message is that today's market looks less like healthy growth and more like a late-stage bubble. Faber compares the current excitement around AI and speculative assets to past manias, in which crowds ignored risk because everyone else was participating. During bubbles, people believe prices can keep rising forever. But history shows that once confidence breaks, the collapse can be brutal. His prediction is that the AI boom may continue a little longer, but the foundation is already weak because only a small number of stocks are driving the market higher. If those leaders crack, the broader index could lose strength quickly. He also sees private equity and private credit as major trouble areas, especially when redemptions are limited, and investors realize liquidity is not as strong as they believed. In that kind of environment, precious metals may not rise in a straight line. Gold, silver, and platinum could fall during a liquidity panic, but their long-term role becomes stronger when governments respond with more deficits and money printing. The deeper the financial stress becomes, the more valuable real assets may look compared with paper promises. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.